All right, so Carl writes in, the topic is whole life insurance as an investment. He says, my wife and me are 60 and 60 respectively, and they just retired this past June. Congrats there, folks. Okay, your videos are helpful. Josh, you're the best. Josh, I love your pearly whites. Josh, you're so smart and handsome. Actually, I didn't say any of that, but anyway, we know that's what they meant. We have been approached by an insurance person selling whole life as an investment. We have 5 years plus cash on hand, and the sales pitch is that the insurance will gain more interest than the bank. We want to hear your take on this. Hold on. Anyway, I forgot where I left off. So we have 5 years cash on hand, and the sales pitch, we already talked about it, is that the insurance will gain more than the interest at the bank. We want to hear your take on this. All right, so here's my answer to him. No, not when you're in your 60s. No. If you're in your 30s and 40s, yes, but the cost of insurance and the commissions destroy the returns you'll get at least in the first 10 years, if not the first 20. And that's even if you get underwritten. You're in their 60s. It's not that easy to get approved for life insurance when you're in your 60s. And a lot of times you might get approved, but at a substandard rate. So I hear this stuff all the time. It drives me flipping insane. Look, I know tons of guys in the insurance business, tons of them. There's a lot of guys that are actually fantastic financial planners. I'll tell you that. Why are you limping, buddy? The drawback is they have a good product, but when you're a hammer, everything's a nail. The problem with life insurance as an investment, the older you get, the more expensive it becomes. The more expensive it becomes, the less interest you accumulate. Now, be careful with whole life as an investment. I tell you, man, this drives me crazy. They will say the crediting rate. The crediting rate, and the implication is that that is the interest rate. This drives me insane. Say, show me an illustration of projections for cash value 10 years from now. Do this. Say, show me your illustration of projections for cash value 10 years from now. All right, what's going to happen is just for simplicity, they'll say we got a 6% crediting rate. So if you get a 6% crediting rate on simple interest, that would mean on $100,000, you would get $60,000 of interest, right? You got a 6% crediting rate on simple interest. I'm not even compounding. That's $6,000 a year times 10. That's $60,000 bucks. I should have $160,000 of cash value at the end of the 10 years if I have a 6% crediting rate. If they're insinuating that's an interest rate, you won't have that. I guarantee you won't have it. Why? Because a crediting rate is just a rate they give to you, but then they take some money away for the commissions they got to pay, the agent, the cost of insurance, the various fees that go in there, all this stuff. So after 10 years, you'll be basically breaking even with your cash value. I mean, that's just a fact. So 10 years from now, you're going to be 70. Now the commissions by then are usually paid off to the broker, so he'll be done. So your fees will go down a little bit because your commissions are behind you. But what happens to your cost of insurance? Well, now you're 10 years older. Now you're in your 70s. The cost of insurance is growing up exponentially, essentially, because you're getting older, that much closer to death. So you might still be getting a 6% crediting rate, but the cost to insure you, plus all the other fees that go in it, are 5.5%, whatever it is. I'm just telling you, man. And I've said this a million times, but I had a young agent on my YouTube channel when I first started out, back 2018, and he was a young buck, I think, with Mass Mutual. And he was saying, we've been giving people 6% interest since 1855 or whatever. And I was like, dude, no, yeah. I said, show me an illustration what it looks like after 10 years. And he said, well, yeah, he said, okay. And I could tell he was a rookie. And I was just like, and he said, well, we got to pay for the interest. We got to pay for the commissions. We got to pay for the cost of insurance. I said, exactly. So you're saying the interest rate you're getting is you're implying that's a net rate of return, and it wasn't. It was not. It's just not. And I said, he goes, well, after 10 years, all that stuff's behind you. Then you get. I said, show me the cash value after 20 years. It wasn't 120,000. 160,000. It wasn't, again, because the cost of insurance goes higher. So where whole life as an investment works, I'm just telling you, is when you're young and you can fund that puppy heavily in your first few years. I'm telling you, man, if you're young and you're making bank, and you should really do a whole life insurance policy. I really believe that. I'm hesitant against universal life policies. I'm not a fan of universal life policies by and large. Whole life policies I am a fan of if you get underwritten well, i.e. you're in good shape, and two, that you can heavily fund that guy, put a lot of cash in there on the front end, and to let that accumulate for 20, 30 years to come. That's actually a pretty good product. But as an older man, and you're just kind of putting money in there equivalent to a bank CD, don't touch a 10-foot pole. All right. Thanks for the question.